Litigation is sure to follow when crypto goes corporate. Until recently, cryptocurrencies appeared to be far from the kind of institutionally sound assets that CFOs wanting to diversify a corporate portfolio would find appealing. Once thought to be gimmicks for naive retail investors, many of whom bought cryptocurrencies based on arcane internet jargon, silly children's songs, or even renowned hip-hop artists, few would anticipate the infamously volatile electronic currencies to find their way into corporate treasuries. The joke appears to be over, or perhaps it is simply getting old. As executives have sought to hide extra corporate funds in electronic currencies, novelty assets have become an increasingly common addition to corporate ledgers. This foray into unfamiliar area, however, brings with it new risks from both private lawsuit and regulatory scrutiny. Similarly, as with any unique asset, CFOs must strike a balance between their desire to invest imaginatively and the worries of apprehensive shareholders. On these fronts, cryptocurrencies pose potential stumbling blocks for those tasked with navigating businesses through modern-day legal and regulatory shoals. Bitcoin advantages. So far, corporate investment has primarily been in what used to be known as established cryptocurrencies, primarily Bitcoin, which have been a part of the financial world for several years. Corporate treasurers, who are primarily responsible for cash and liquidity management, have generally invested in low-yielding, low-risk assets such as money market funds, government securities, or commercial paper. So, what would compel a well-established corporation to convert its precious assets into a currency whose value fluctuates dependent on internet message boards? The main answer is straightforward: inflation. For many people, Bitcoin and other established cryptocurrencies are a form of digital gold, an asset that should theoretically retain purchasing power when other assets, such as currencies subject to fiscal and monetary policy, may not. As financial commentators have noted in respect to Bitcoin, the cryptocurrency might serve as a hedge against inflation generated by central bank monetary policy because there is no central bank involved in regulating its price and the supply is set. With fiscal stimulus entering markets in the aftermath of the COVID-19 pandemic, inflationary fears have made fixed supply cryptocurrencies more appealing to certain firms. Companies and CEOs known for bold, forward-thinking corporate strategies are leading the way. MicroStrategy Incorporated, a software business, is in the forefront of this movement, boasting that it has been placing billions in corporate assets into Bitcoin and now claims that the bulk of its corporate treasury is in the cryptocurrency. Square, a financial technology startup led by Twitter CEO Jack Dorsey, also has a corporate stake in Bitcoin worth more than $200 million. Elon Musk, on the other hand, is the clear center of gravity in the field of innovative financial technology. In fact, some believe that his public views regarding cryptocurrency markets have impacted the asset's price on their own. Musk has been a strong supporter of Bitcoin and has been at the forefront of the corporate transition to Bitcoin investing. Musk's electric vehicle business, Tesla, reported that it had purchased $1.5 billion in Bitcoin in a February 2021 SEC filing. Since then, Musk has remained tight-lipped about the company's digital assets, but he has been the most prominent business executive to imply that digital currencies are the wave of the future for smart global corporations. Musk has also indicated that Bitcoin may be used for retail sales. Musk stated in March 2021 that Tesla consumers would be able to purchase electric vehicles with Bitcoin. Almost immediately, detractors pointed out the environmental costs of Bitcoin extraction, known as mine, and suggested that the climatic consequences of increased cryptocurrency use were incompatible with Tesla's green image. Musk was forced to backtrack on accepting Bitcoin for consumer purchases. However, the company stated that it will continue to invest in the digital currency. Musk's support is not limited to Bitcoin. He recently stated that he would not sell another cryptocurrency, Dogecoin, and even stated that SpaceX, Musk's commercial rocket firm, would launch a Doge-funded mission to the moon. It remains to be seen, though, how much of Musk's interest in cryptocurrencies is genuine or joking, as his comments on the subject have coincided with huge price variations. Risks of cryptocurrency. Cryptocurrencies, as one might anticipate from a novel asset class with a tumultuous history, pose distinct legal and regulatory dangers. First and foremost, corporate executives must assess if investing corporate capital in cryptocurrencies impacts their fiduciary responsibility to shareholders. Cryptocurrencies are not without critics, some of whom almost certainly own stock in corporations that have used or are considering utilizing assets to purchase cryptocurrencies. Although shareholder lawsuits based on cryptocurrency acquisition have yet to reach the courts in significant numbers, as more corporations fill corporate coffers with Bitcoin and other digital currencies, more litigation from disgruntled stockholders may follow. The most obvious legal risk is that, despite their theoretical promise as fixed and intervention-resistant assets, cryptocurrencies are volatile. Cryptocurrency markets may be exceedingly unpredictable, as evidenced by the recent and seemingly arbitrary fluctuations in prices. Prices have fluctuated significantly in recent weeks. This apprehension is not restricted to fresh or exotic digital assets. Bitcoin recently fell about 30% in a single day, owing in part to China's crackdown on cryptocurrency transactions. Recent market volatility in Bitcoin's price has some wondering if the cryptocurrency may be used as a hedge against growing inflation. Furthermore, as governments tighten regulations on the purchase and selling of digital assets, the risk of a catastrophic loss for people with big interests in digital assets will only grow. If such losses affect corporate treasuries, CFOs and other executives may face allegations that they mismanaged corporate assets. Aside from volatility, cryptocurrencies highlight an even more fundamental issue: storage. A cryptocurrency is often held in a digital wallet to which the owner is given a confidential access code. If the owner misplaces this code, there is frequently no practical method to retrieve the digital assets, which has resulted in some cryptocurrency owners being permanently locked out of their digital wallets. Human mistake isn't the only problem with storage. Cryptocurrency wallets are equally vulnerable to hacking. Corporations that take substantial public investments in Bitcoin may become prominent targets for digital theft as a result. If the corporation did not take proper security steps to secure its Bitcoin investment, either loss might result in shareholder lawsuits for misuse of corporate assets. Furthermore, as Musk's reversal on Tesla's acceptance of Bitcoin payments demonstrates, the environmental impact of cryptocurrencies may have an impact on their viability as a business asset. According to one study, global Bitcoin mining consumes the same amount of energy as the country of Sweden. Corporations that invest extensively in cryptocurrencies will face rising pressure to account for that investment in their disclosures of climate impact, as investors become more sensitive to firms' environmental impact and are willing to pursue shareholder initiatives to force corporations to be loyal stewards of the environment. Entities that are not transparent may face shareholder lawsuits alleging that they withheld information regarding the environmental hazards of their investments, causing the company's value to fall. Companies must also ensure that any investment in cryptocurrency is compatible with earlier corporate statements, lest shareholders file claims alleging that the past statements were false or misleading. Investors have utilized a company's general comments about its environmental, social, and governance (ESG) policies in other issue areas as the foundation for a securities class action where the company's behavior was incongruous with its aspirational claims. As a result, a company's broad comments about its commitment to sustainability may be regarded deceptive if it invests in resource-intensive digital assets. CFOs must also exercise caution to ensure that corporate investments in cryptocurrencies do not contradict earlier public comments in a way that could be construed as deceptive, lest the company face legal action. Other aspects of cryptocurrency may also give rise to legal action. For starters, digital tokens are still on the outskirts of the financial sector. Because most crypto transactions are largely anonymous, they have become the money of choice for criminals of all sorts. Even genuine businesses are putting their corporate capital into an asset class with an unknown track record and reputation. Indeed, the decentralized and uncontrolled character of cryptocurrencies, which are key selling features for some investors, means that corporate executives are left in the dark about the legal ramifications of their investments. For example, there is no cryptocurrency-specific guidance for businesses on how to account for Bitcoin holdings on their corporate ledgers. The Financial Accounting Standards Board, which establishes accounting standards for firms in the United States, has yet to establish guidelines for Bitcoin in particular. Generally accepted accounting principles, GAAP, in the United States are also quiet on the accounting of digital assets. So far, so good. We hope you enjoyed watching and listening to this video. Please let us know your opinion in the comments area below. If you found our content useful, please like it and share it with your friends. Also, don't forget to subscribe to our channel and hit the notification bell for more crypto-related contents.